What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Ray. How you doing today, Ray?
I'm doing fantastic, Dan. Thanks for having me on, man.
Oh, my pleasure. And I got some great news for you today, Ray. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate players. That means buyers, sellers, deal sponsors, passive investors, operators, all that kind of stuff. And you might be thinking, why would you do that? And the answer is, if you've ever heard of a private off-market deal, sometimes called 506B deals, you're not allowed to publicly discuss them until you have documentation of your prior substantive relationship, or else the SEC will get ants in its pants, and you don't want that because they can take your entire business away. But the best news for you is you'll not only learn how to more effectively communicate on the subject of commercial real estate deals, but you'll also find out how my guest fits into those deals as well. But before we get too excited about real estate, Ray, do you want to introduce yourself a little bit?
Sure. Yeah, I'm Ismael Reyes, and I was in the military for 20 plus years, 28 years actually, and retired as a lieutenant colonel so that I could do this full time. It's always been an itch that I needed to scratch, and once I served my country, I figured it was time. I invested in real estate along the way, but really at an individual level. So really just wanted to jump into the commercial space, and here we are.
I love it. I love it. Now, let's get into the first little segment here, the 5 distinct motivations. Of course, before I do that, though, I have to say, but wait, check your 8. Now, Ray, I don't know if you can do this, if you have the technical knowledge how to do this or not, but maybe you can look through your camera and down there into the user's device. There might be this big, hideous subscribe button, and maybe they should do something about, okay, it's a stupid joke, but I do it in every episode.
Press it, man. Press the button.
Yeah, that's the ticket right there.
People
All
like
right.
Dan and I, we live on engagement and networking, and that's the way to do it.
Yeah, absolutely. Yeah, those deadbeats at YouTube, they're not going to do anything to scratch our backs unless we really make work the system. But let's talk about motivations. I've now interviewed hundreds of different commercial real estate players, and everybody has their own unique reason why they got into it, why they stay in it. And that's really the important thing to know is, what's going to keep somebody from throwing in the towel when the going gets tough. But even though there are all these different unique reasons why, I found that they fit pretty neatly into these 5 different categories, and that's why I go through them in every episode. The first one of which is preservation of purchasing power. What on earth is that? Well, some people already are job optional, or at least they earn more than they tend to spend, and so they have investment capital lying around on the side. But the main idea is if you are in that kind of situation, you need to be figuring out, well, why would you be doing these, if you're work optional or whatever, why would you go through the hassle and effort of another acquisition? Well, the biggest ones that come up, the biggest reasons that come up are inflation rearing its ugly head, eating away from the purchasing power of your cash flow. And then the other one that is more important to understand, everybody, when they're making a real estate acquisition, you should try and negotiate the most competitive price you possibly can. But people, when they're really focusing on preservation of purchasing power, that becomes even more important. So people in this situation, they frequently don't have to pull the trigger, every 10 minutes like a REIT or something like that. They don't have to be acquiring constantly. They're more going to pick up a new property when there's like an asset crash or a significant discount. Now, full disclosure, I'm not at that point in my real estate career yet. What describes me better and the strategic partnerships that I've had is I'm trading time directly for wealth. And what that means is that it's because I have a background in technology, specifically the CRM and online funnels, full stack development side of online businesses. And so as I started getting bigger and better clients, I eventually started working for a guy who was flipping 10 houses a month, doing 10 house transactions per month for years before he hired me. That told me that I was on the wrong side of the right business once I was working for him. But it also hit me that searching for that ever bigger and bigger salary is not really the best strategy out there when you can work in return for deployed capital, aka equity. So that is my priority, and I get that that is a little bit abstract, especially for youngsters. And frequently youngsters and other people, they say they want to fast track their retirement. What they really mean is they want to hustle like crazy now, and then they want to be able to take it easy later. But the more pervasive reason for why people choose this option is because they just want to control their schedule. They want to have that time freedom, and that's one of the things that real estate I've found actually can. It's a promise that it actually can keep, because you will be able to make those baseball games with your kids, that sort of thing. But one flaw or downfall in people who tend to have this as their main motivation, the mistake they tend to make is they think that everybody secretly is trying to retire, and I assure you that's simply not the case. For example, there are some people who want to buy their entire hometown. They want that generational wealth. They're really fueled by ambition to have their name on some building or something like that at some point, or the biggest yacht in the pier. And so that's why they're going to hustle into their 90s. It's to make sure that their great-grandchildren never have to hold a day job. And that, I know that that's also vilified in some circles, but the fact is that somebody has to be at the wheel and motivated to keep going, even as the business goes on. And so that's why they're great members of the GP team, even if that's vilified in some circles. But the last one, which is a little bit more on the positive light, it's some people, they're not so concerned about their own legacy, but they've picked instead a sector of society, or maybe it's animals, the environment, who knows what it is, but they found out that if you really want to make a big impact, there's a financial component to it. So they're going to be hustling into their 90s as well. So Ray, of those 5 different motivations, what combination of those 5 would you say describes you best?
I'm glad you said combination, because they certainly resonate. More than one resonates with me. I like the generational wealth aspect of it. I mean, I came from a very blue collar background, and so anytime that I think about what I want to do for my kids, I want to be able to give them that, and not just them, but their kids. I mean, it's interesting that not everybody, while we all, live in the same, all of us, thankfully, at least probably most of your audience, or maybe the majority, live here in the US, and we have the same freedom. We don't all start from the same start point, right? Some people go a little bit further back, and some people are almost at the end when they're actually, starting off their track. So generational wealth is important. But I'm also one of those guys, I've always had an itch for real estate specifically. And I've always wanted to thrive in this space. And honestly, when I left the military, I was busy as all get up. And now as a real estate entrepreneur, owning multiple businesses, acquiring multiple assets, and now I have my own fund that I bring investors through the fund on. I enjoy being busy. I enjoy the work, and I enjoy that it helps others also. So I also do some offline, if you will, consultations, but not as much because my time is limited. But there's at least 3 reasons in there from your 5 that I can really resonate with me.
I love it. I love it. But one of the problems of discussing motivation, the source of why we're doing this, it runs the risk of seeming a little bit too optimistic, a little too starry-eyed. And I put a pin on that by this next question, which is more about tolerance for risk assessment. Because after all, the fact is there are risks involved. These deals take months to close. They take years to go full cycle. And we need to keep that in mind. But if you've ever been involved in one of these off-market deals, these private deals that you're not allowed to publicly discuss, then whoever the securities attorney in the mix was, they should have insisted that everybody filled out this highly invasive financial questionnaire, which includes questions like what's your net worth, your current investments, all that kind of stuff. And when I was going through one of those 506B style suitability questionnaires, the one question that really popped out to me as being problematic, more specifically it lacked utility, was the tolerance for risk assessment question. So for this interview, I've made my own, and it's a fill in the blanks question. It is, there are many popular investment classes, but I think blank is too risky. So Ray, it can be inside real estate, it can be outside real estate, but what's too risky for you to invest in?
Yeah, I definitely don't recommend that anybody invest outside of their knowledge base. There's a lot of sexy stuff out there. I'm not, and I don't want to talk about blockchain and other things because there's some people that really understand it and really are comfortable there. I would say for me, I would say within the real estate, commercial real estate space, I would say that office is a tough business right now. So investing in office in and of itself is very difficult right now.
Yep, I love that answer. And it actually shows a great level of sophistication, quite frankly. And speaking of level of sophistication, this next slide, this next question, for the first couple hundred chance encounters, I wanted to include this, but I felt that it was a little too much of a gotcha moment for especially the syndicators or people who are like more front of house, their public relations, their marketing, that sort of thing. So they're not going to be diving into the spreadsheets. They're not actually going to be doing the underwriting themselves. They're going to be relying on somebody who is constantly happy inside those Excel sheets and all that sort of stuff. And so if you ask them, hey, what are your favorite metrics? I thought it was a little bit too much of a fastball. But I've found that even people who are on that front of house sort of role, they'll still stick to a few different metrics that they use to discern this deal from that deal. And for anybody in the audience who's only listening and not watching, I'll read out this list here, and I think there's 14 of them on here right here, and we can do like a top 3 or something like that. They are cash on cash, IRR, which is internal rate of return, which is an equity multiple. There's the cost per door. There's the net operating income of the property. There's the going in cap rate, which really means the difference between the comps in the area and what you're paying as far as cap rates, because that's published detail of commercial acquisitions. Then there's the loan interest rates, which is especially important if you're going to be assuming a loan or if there's some sort of seller finance, some sort of thing like that. Then there's the occupancy rate, which is the inverse of vacancy. So it's basically the same number, just inverted. There's the average income where the property is located, the amortization period of the loan, especially important if you're going to be assuming one. And then there's the difference between the market versus the in-place rents. There's the population growth where the property is located. So you have sort of some baked in appreciation due to increased demand, more people needing housing. Then you have the sponsorship record, which means how many deals are on the go right now, how many deals have already gone full cycle. There's the waterfall split or exit strategy, which means what happens to your investment after your capital has been returned. And then there's DSCR, which is debt service coverage ratio, which is talking about how much of the revenue from rents and amenities is actually going out the door pretty much immediately in the form of the loan. Now, of course, this isn't an exhaustive list. So Ray, if you have some others that you want to mention, you can go ahead. But do you want to give some of your main ones that you focus on?
These are all very good. I would add to your list exit cap rate. When you guys are looking at deals, when folks are looking at deals, find out what the exit cap rate is, and if it's or at the same level of when you buy, it's probably dangerous because what you're assuming is that you're going to be able to sell at the same cap rate. And commercial properties are not based on comps; they're based on typically on NOI, and cap rate plays a portion in the sales price there. So exit cap rate, I would say one. The other one is your all-in basis. And that's not a specific term, but just something to understand. When you're buying a property, particularly if it's a value-add property, you have what it costs right now. Just do the math, right? You buy at a certain price, there's a certain amount of units. That's your going-in basis, but it doesn't include your CapEx, which is another portion of that. So take a look, because you may find out that what looks like a very nice asset is not that good when you end up you adding all the capex that gets done, and next thing you know, a property that you thought was 100,000 a door is now 180,000 a door, and it's a C-class property. Math doesn't work, no matter how pretty it looks.
Yeah, I love that answer. I'm gobbling it up like a delicious subscribe sandwich, which is my ultra intense reminder that it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different key roles in a commercial real estate deal. And I go through all 6 different roles so that you know if one of them are missing, there's probably something up with the deal. But also it helps you learn how to more effectively communicate on the subject of commercial real estate deals, which if you're going to make this part of your career or investment strategy, I think your success is going to hinge on that ability to communicate effectively. But the other thing is you'll also know how my guest fits in. And if, as I'm going through these different sides, you're sitting there thinking, wow, I need to get my hands on one of those cubes. Well, the good news is they're absolutely free. You just go to dandoesdeals.com and there's this big conspicuous button. You can click on it. It goes straight to the PDF. You can print it out and you can practice on your friends and your family and all that kind of stuff. That's right. You heard me correctly. I broke the cardinal sin of marketing, which is you should never, ever give away your freebie without asking for some sort of contact information like an email address or something like that. But I do want you to practice these. Now, the first role I want to talk about is the repositioner role. That is a person who's in acquisitions. They look at a whole bunch of different properties. They do a whole bunch of paperwork. What's that paperwork? Well, first, they have to underwrite the deal. In other words, they have to figure out, hey, is this property even making the amount of money that the seller / broker is claiming it is? Because right? And then the other thing is that I call them repositioners to make them distinct from all the gazillion types of investors that are out there, because a repositioner's job is also to figure out how can they change how the property is run so that they can find more upside. But before they even pick up the property, one way they can find some upside, and it's honestly the most peculiar part about repositioners, I think, from an outside perspective, is you're going to say, well, why are all these repositioners rubbing elbows with financiers? What's the deal with the financiers? Always looking for different banks, different lenders, investors, all that sort of stuff. So financier relations is part of every repositioner's job. But the reason for that is because if you can secure a more advantageous loan, aka cheaper money, that goes straight to the profitability of the building. So that's a huge advantage right there. So that's why they're constantly talking to them. The next thing that the repositioner is going to do to find more upside is they're going to take a look at operations and figure out where those Benjamins are going down the toilets. Now, of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns, taking out garbage and that sort of thing. Me personally, in my GP experience, it stems from my digital repertoire of things I can do. And the other big thing, though, of course, is that if you're looking at bigger properties, which I have traditionally had my eye in, because I don't know if you know this about me, but I'm from the internet. So that means that I'm a remote-based guy, which means my contribution has to be possible from that. And that means it tends to be bigger properties once more. And when you have bigger properties, you're usually outsourcing operations to a third party. And then the only real contribution you can do, because that company is supposed to be basically taking care of everything, is if they cannot fill the units, you need somebody on the GP team with some serious marketing chops to get those units filled. And that's one of the things that I would frequently throw my hat in the ring for as a GP. But of course, the next thing after operations that the repositioner is likely to do is to get a contractor team involved to do a value add, do some CapEx, capital expenditure on different upgrades. The idea being that the future residents should be more than happy to pay more in rent than the previous ones because it's a nicer place. But if only things were that easy. You can spend endless amounts of money on CapEx and it won't necessarily turn into an ROI. Because after all, like if you're gold plating toilets, it's who's going to be paying for it, just as Ray was saying earlier. But the other issue of having the contractor team involved, especially if you're from the internet like me, is that you need locals. You need boots on the ground, okay? You need somebody who can be there in an hour or two, And categorically, that's not going to be me because I'd be stuck at an airport in an hour or two. So you have to have somebody who can be there, figure out how to fix bigger problems and all that sort of stuff. Make sure that the contractors are keeping to schedule and they're not using subpar materials. Make sure that the operations aren't just sloughing photographs and different things as far as how the property is actually being run, and just generally have that accountability piece. Now, it sounds like I've just described everything you need in order to take over and run a commercial real estate building, but it's not. And let's do a little hypothetical so you understand the last role. Perhaps you are a physician or a surgeon or an attorney or an engineer or something like that. Maybe you already have a couple of single family homes that you rent out, and you think to yourself, hey, I'd like to take over that 300 unit apartment complex down the road. And I bet, because I know how you buy rentals, you just put down the down payment and then you borrow the rest. You think, hey, I bet you I could get my pals to each kick in maybe 100K each and we can take over that property. So full of confidence in your new repositioner role, you turn around to the banks and financiers and say, hey, in order to take over that building I want, I need tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us, do you? And they're going to stop you right there and ask, who's your sponsor? Who's your KP? Now, if you're in some sort of mentorship program or you have a guru or something like that, this is the part that I think you really need to pay close attention to, because the fact is the bank is in the business of protecting capital from its depositors. So that means they're not going to lend you tens of millions of dollars unless you have proof that you're not just going to pick up the property and run it into the ground and make that money unrecoverable. So what they're going to do is they're going to require that somebody on the GP team already owns a similar asset. Okay, so you need to have somebody who already owns a 300 unit apartment complex if you want to be buying 300 unit apartment complexes with a loan. Of course, on top of that, you need a certain amount of liquidity to prove you can actually run the building. And then you also need a balance sheet for collateral of at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So Ray, you already mentioned that you have your own fund. You're obviously in the repositioning side as a fund. That makes you also a financier. But are there other roles that you're really going to focus on your next deal, most likely?
I think the biggest thing it's that, and you've talked about it as a fund, the biggest thing that we need to pay attention to is really who we're doing deals with, because it's one thing, and we've done this. We have over 500 assets under management right now, so it gives us some requisite experience there. That means that we're on the GP team and we're in all the meetings. We're involved day in and day out. Sometimes it's weekly, depending on where you are with that deal. But you're involved in the weeds. I mean, you're asset managing this property. We may not be boots on the ground, to your point, but we are involved on a regular basis. But transitioning to the fund model, it's different, because now what we're saying is, I'm not going to be involved in the internal operations of that deal. I'm bringing capital to bear into the deal, and I expect some reporting from the sponsor and the operations asset management team, a recurring basis, making sure that we're informed and we're able to do our analysis, but we're not in the weeds. So the biggest thing that we've got is really we have to do a very thorough due diligence of that sponsor. And I'm not talking about what they give you on an offering sheet and it says I have these many doors. No, it's a full-blown credit check. It's calling some of their references. If they're not willing to give you references, probably not a good sponsor to deal with, because they should be able to give you references. Find reference. This is kind of a small world in the multifamily space. So even if you have references they've given you, find some that you just find on your own through your own network. See what they say about the sponsor. How do they communicate? So we can go on, but the most important thing, and the thing that we've kind of gone and really fleshed out completely, is the ability to do a full-blown vetting of these sponsors. Otherwise, we won't do the deal. And even if the sponsor looks good, once we get to that point, all that means is now the next deal that they put in front of us, we're going to analyze the deal because we've already analyzed the sponsor.
I love that answer. I love that answer. Now, the next question then, it has to do with the buy box. And if somebody is in real estate and they're asking for, hey, what you're looking for, what's your ideal property, what's your buy box, we're mainly focusing on three things. The first one's geography. Where is it? Which state, which county, possibly even which neighborhood? It's definitely going to matter before it's somebody's just going to jump at the opportunity. Now, the second one is size. And when you're talking multifamily, we talk about unit count, the number of apartment units. And the reason why it's relevant is because the type of company that takes over 5, 10, 15 unit apartment complexes, they're going to be fundamentally different from the type that take over 150, 350 unit apartment complexes. So that size definitely matters. Now, of course, there's other types of real estate, other types of commercial real estate where it doesn't go by unit count, maybe it goes by square footage or acreage, but that size concern still applies. So that's the second one. The third one, though, is usually called class. I prefer the term desirability, not only because it's more than one specific thing, but the other reason is because they're completely separate things under the label class. And those are, there is the condition, and then there's the area where the property is located. When you're talking about condition, we're talking about how old is the property, how beat up is the property, how recently updated is the property, and then of course what sort of amenities and luxuries are there to make it a nicer place to live. Whereas when you're talking about the area, especially if it's residential like multifamily, the crime rate's always going to matter for every type of real estate, but the school districts are more relevant as well when it comes to the residential properties. But the other one is the old broker trope of saying location, location, location. I don't really like it because I don't think it's informative enough. It doesn't really tell you enough. I think traffic, traffic, traffic is a better saying, because if a gazillion people pass by that property every single day, it makes it automatically more desirable. But both of those forms of desirability, the area and the condition, they're ranked the same way as back in grade school, where you have A plus at the top, and then A minus, then B plus, and so on. So Ray, as far as you and your fund goes, what's your sweet spot?
Yeah, we use very similar initial analysis. We do a big 3 plus or minus R, if you will. It's essentially, we're looking at the demographics, population growth, economic growth, and we're looking at unemployment numbers. Unemployment's been pretty low overall, but we're looking at the trend more than anything else. And then the minus R is really the risk. We have two levels of risk. We have, at the macro level, we're looking at what the business climate is at the state, county, and city levels. And then the other risk you mentioned, which is crime, that you really have to zero into the specific zip code and neighborhood to make sure you get that right. Having said all that, I've done Class C properties. We've done Class B. My sweet spot right now is Class A. Class A properties in great markets that have too much volume right now, because it's, multifamily was such a great thing right after, during and after the pandemic for developers, that they overbuilt. But if you overbuild in a bad area, there's no solving that. But if you overbuild, to your point, Dan, in an area that has high traffic, now that buyer has an opportunity to buy something at a low basis, a low cost, and it's brand new. So that's kind of where we're focusing right now as we're going into this next section or next time. We got elections coming up and all kinds of stuff going on. And C class, it's just a little too risky for us at this point. You do have a rental income class that's much, much harder. So we like the A class, where there's a lot more price elasticity for those rents.
And which states to start are you mostly focused on?
Good point. Yeah, we like Sunbelt. I've liked Sunbelt a lot. I like Florida, depending on where, right? I stay away from the coast at this point. We had a bunch of Tampa stuff that we got rid of, did very well, but we're looking at, Central Florida and really up the middle of the peninsula as kind of the better angle there. And then I like Texas a lot. In fact, we've got a deal right now in Dallas, Fort Worth, of a Class A asset. One of those markets that was overbuilt, but now you're finding great opportunities of properties that are really being sold, and at least this one, lower than it costs to build. So when you can find something like that, that's great. So I think those are my two biggest focal areas within the Sun Belt. Now we'll go outside the Sun Belt with particular operators if we like those markets because we're depending on them. We had an acquisition in South Dakota for 278 units that's done fantastic with the operator that we're working with now. So I'd say for Sunbelt focused, but we'll take a look at other markets, particularly in the Midwest right now.
I love it. So let's talk about people. It's by far my favorite part about me switching from antisocial tech guy to real estate. I think it's really because in a commercial real estate deal, it's so multifaceted. People have these different roles in their in this different ownership, running these different properties, and so because of that, we're also eager to make referrals. Build new teams, even if we're not going to be involved in it, but at the same time, we all have our own unique skill sets, and so that means we're going to be better suited to help some people more than others. Now, it goes without saying that everybody in real estate is ultimately in the business of deploying capital, so everybody is eager to meet more investors and financiers and all that sort of stuff. Me, because of this podcast right here, I'm eager to meet anybody who's on the cube, just so that we keep on giving more value to you in the audience as far as having more people to consider for getting involved in these different deals. Traditionally, though, it's been the sponsors and KPs that I've been most eager to speak with because, I'm doing a lot of live events, a lot of speaking on stages, just like both of us were this last weekend there, Ray. But as far as sponsors and KPs, they're very valuable right now because a lot of my activities are related to the debt fund that I'm involved in out of Arizona. It's really more the financiers, the private investors that are looking for other ways to get proceeds from real estate that I'm looking out for. Now, Ray, I imagine most of what you do is 506C, which means you can say whatever you want. If you do have any 506B deals, don't go saying that you're looking for investors in the same breath of saying that you have this property that you're taking over. But who's out in the audience that you're most eager to speak to, Ray?
I mean, honestly, it's operators from a different perspective because one of the things, if you do this long enough, eventually you're gonna have two things happen. One, you're gonna have capital that you can't deploy because you don't have deals to put in front of them. That's one problem set. Then the other problem set is you may have deals, but you don't have the capital. So you have to pick your poison. They're both important. You got to do both. So for me, it's finding operators so that I can bring enough value and diversify the fund, which is a 506C fund, diversify the fund so that we can give our investors an opportunity to diversify. And it's a customizable fund, so they can specifically invest in a particular deal that they like, and they don't necessarily have to partake in something they don't like. So it's another value to the fund. But yeah, I would say that from a 506B perspective, because I know your audience, some of them or most of them may be 506B, who knows, right? A lot of people watching. But I would say that a lot of deals right now are being done and that are hybrid. They start out at 506B, nobody hears about those. And then at some point, once they reach that 35 magic number, 35 investors, that's all you can have in a 506B. When you hit that, now all of a sudden they shut it down. It's no longer a 506B, and now you go 506C, and you can blast that out. But only accredited investors can invest at that point.
Exactly. So now I'm sure plenty of people in the audience are thinking, how can I reach out? A couple notes before we get to that. I'll sandbag it here. If you're looking to raise capital for your business or real estate deal or something like that, I encourage you to pause the video and scan this QR code to go to the FAQ page of 506BME. It'll tell you a bunch of details that you need to know about documenting your substantive relations. Of course, I got this stupid hat that says real estate is a scam on my head. I gotta, address that little elephant in the room, and that's an edutainment site, I guess you should call it. It's basically talking about things that are risky elements of being in this industry, and some people, especially gurus and mentors and stuff like that, they want to kind of sweep them under the rug. And I wanted to say, skeptical, here, hold my beer. But I didn't want to just basically be negative. Instead, I also include what full-timers do to make sure you don't lose your shirt for these highly predictable reasons. But if you do want to reach out to me, LinkedIn is the best way to do that. I spend most of my social media time on there. Unfortunately, I got this super distinct last name. It makes me easy to find. Ray, I know you're also super active on LinkedIn, but I don't want to assume that's the best way to reach out to you. Is it social media? Is it a website, email, phone? How should people reach out?
Yeah, I think LinkedIn is the best. IsmaelRayReyes.com is also available, and I do both. I love talking to people about these things. There's a lot of knowledge and a lot of myths. To your point, I love the hat, by the way. So there's a lot that we can discuss. My time is valuable, just like everyone else. So we keep them short, 10, 15 minutes if we're going to engage and decide, what, if anything, I can help them with, and if they're really interested in investing. So those are the two big ways to really get a hold of me.
I love it. I love it. And of course, now all the seriousness aside, I have to do my public service announcement to wrap up. It's not for you, Ray. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that's down there that you can just get rid of for free. You just hit it and it goes away. And full disclosure, the reason I want people to click on it is because then those deadbeats at YouTube might actually start paying for these videos instead of me. And I think that would be fantastic. The trade-off for you is my videos may show up on your list of suggestions. There's a high chance that it won't. You can go ahead and ignore them if that's your thing. But it's okay to ignore them just because, quite frankly, I appreciate the fact that you spent this time with me. Just like Ray, I appreciate you joining me. This has been great.
Thanks, Dan. I appreciate it. Hopefully your listeners are paying attention and they reach out to you or me.
Awesome. Thanks. Oh, hey there. I hope you enjoyed the show. And if you are into chess, if you play chess and you're an investor of some sort, real estate or otherwise, well, you can be on the show too. I know, right? All you have to do is connect with me on LinkedIn. My name's Dan Friedenberg, so I'm super duper easy to find on LinkedIn where I spend most of my social media time. But if you're one of those people who just don't play chess, don't pay attention to him. I don't judge. All you have to do is go to dandoesdeals.com and you'll find the Chance Encounter series where you're welcome to be a guest on it, where you can share your core competencies that you're likely to contribute to a GP team or a JV. You don't have to be doing syndications. And we'll talk about your buy box and stuff like that. It's easy peasy. It's like 15 minutes long to record, and there are no real fastball questions. Just tell the truth, and everybody will be fine. And if that's not really your thing, dandoesdeals.com. It also has the way to meet more, join more people, add more people to your investor list, your different deal sponsor operators and KPs. And passive investors, all that kind of stuff. I'm probably repeating myself, but I'll give you the rest of your day. I appreciate you watching Chess with Investors. See you next time. Bye.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself? You can go get 13 or 14%. You're going to do all the underwriting. It's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, wherever you're at.